Hello, and welcome to the Fin Know-How video on analyzing financial statements. As you may remember from our prior discussions, financial statements contain a wealth of information about a company's operations. What we're going to do today is to take that information and figure out how we're going to make sense of it. How do we uncover the story behind the numbers and learn how to use these insights for better decision making? So that's the goal of today's discussion. But before we jump in, it's often helpful to think about who is performing the analysis. And the reason for that is that while the information is the same, the perspectives of the analyst changes what questions are being asked of the data and changes what analysis needs to be performed and what metrics need to be tracked. Okay. So it's, again, not just for accountants. It can be used by a whole host of people, sometimes for internal use, as in the case of business executives, or used by external third parties, such as equity analysts who rely on it for investment decisions, lenders who perform credit risk analysis to decide whether a loan should be made to the company, and similarly, analysis performed by vendors to determine whether it makes sense to provide a expensive piece of capital equipment to the company on credit, and so on, right? And so each perspective shapes the question we ask and the kinds of metrics we prioritize. Now, one other thing that I wanted to call out before we get into the weeds is our two principles, guiding principles, if you will, that help you perform financial analysis of financial statements better. The first one is the principle of thinking relatively. What we mean by that is that absolute numbers are hard to compare. So if a company reported $100 million in profit and another company reported $200 million in profit, without knowing more about the scale of operations or the amount of assets deployed to generate that level of profits, you can't tell which company is more efficiently managed, well managed, or more successful. Therefore, each measure of performance has to be evaluated not in isolation, but relative to some benchmark. So for instance, if you're going to go back to those two companies, you might get more insight out of those two numbers if you are able to compare the two companies with a little more context about the amount of sales they generate or the amount of capital employed, the number of employees they have, and so on, right? So the basic principle here is that when comparing companies or when looking at numbers in financial statements, you can get more out of the analysis if you were to benchmark each of those numbers relative to some metric that makes sense in the context of the question that is being asked. The second principle is about matching time periods. This is best illustrated using the example of Amazon, and think of Amazon's fourth quarter, the quarter that covers the October through December timeframe. As you are aware, that period includes the peak holiday shopping season. So which means that of the 4 quarters that in a year, Amazon's sales are likely to be the greatest in the fourth quarter. So if I'm comparing Amazon's performance in the fourth quarter to another quarter, I have to be careful to make sure that I'm not comparing Q4, for instance, to Q1, because the business circumstances under which the company operated in Q1 is very different than the business circumstance or the environment in which the profits in Q4 were generated. So if the comparison is to be appropriate, you have to compare Q4 of this year with the Q4 of the prior year, right? So on. So again, the basic point here is that you have to be careful when you do comparisons so that you're comparing periods of time that align in terms of economic and business circumstances. Okay. Now, with those two principles in the back of our mind, we're going to start focusing on specific types of financial statement analysis. And the first one we're going to look at is profitability. So profitability is a metric that tries to answer is the firm profitable? Now, keeping with the spirit of thinking relatively, to answer that question, we need some benchmarks against which to evaluate as well. So we'll keep that in mind. Now, when you say profitability, you may remember from our income statement discussion, there are multiple measures of profitability. There's the gross profit measure of profitability, where you deduct direct and only direct costs from sales. So what's left is the gross profit. So sales minus direct costs is otherwise known as cost of goods sold is gross profit. So that's one measure. Now, if in addition to measuring, in addition to deducting direct costs, you also deduct out indirect costs, then you end up with another measure of profit called operating profit. If now you deduct out further financing costs as well, you have yet another measure of profit called net income level of profit. Now, there is, of course, a variant on the operating profit measure called EBITDA margin, or EBITDA profitability, where you add back depreciation and amortization, given that they are non-cash expenses. But the EBITDA as well as operating profit measures relatively similar indications of profitability. Now, again, in the spirit of benchmarking it, we divide each of those measures of profit by sales revenue. So if you divide gross profit by sales revenue, you get a margin. You get a profitability measure called gross profit margin. It tells you whether the sales revenue from the sale of those goods is high enough to cover the direct cost of producing it. And the higher the revenue relative to the direct cost, higher the gross profit margin. Operating profit margin is nothing but operating profit divided by the same denominator, sales revenue. And it tells you how much the revenue covers both direct and indirect costs. Okay? EBITDA variant on the operating profit does the same calculation. EBITDA margin is EBITDA divided by sales revenue. And then finally, you have the shareholder measure of indicator of profitability, which is net income margin, which is net income divided by sales revenue. Okay. Now, particularly as it relates to operating profit and net income margin, the interesting thing about the operating profit margin, it tells you how much profit the company is making without taking into account how the firm is financed, right? Because there's no deduction of any financing related expense when you compute operating profit. However, in the case of net income, you're deducting out direct, indirect, and financing costs. And as a result, shareholders are very interested in this measure because the net income represents the profit that the shareholders can access, because it represents the measure of profit after all other stakeholders are paid off. So as a result, from a shareholder perspective, the net income margin is a more relevant measure. But if you look at the company as a whole across all forms of financing, all forms of capital providers, then the operating margin is a better measure. And it's a variant, of course, EBITDA margin is a slight tweak on the operating margin measure. So we have 4 measures of profitability. The numerators are different, denominators are all the same. And the last thing I would make on this page is that you will see that all the inputs that went into all of these four measures came from the income statement and the income statement alone. The profit measures came from the income statement, as did the sales revenue. So this is a within income statement set of ratios or operating metrics, profitability metrics. Next, we are going to switch to a different set of ratios that considers balance sheets in addition to income statements. Okay, so there the focus is not just on profits relative to revenue, but also profits relative to the resources deployed, the assets and the capital deployed that allowed for these profits to be generated in the first place. Okay. Before I get into that, though, I want to refresh our memory about the balance sheet. As you may remember, the balance sheet has two columns. The left-hand side column, which has a listing of all of the assets that are acquired by the company for its operation, and the right-hand side of the balance sheet, the right-hand side column of the balance sheet, that lists the various forms of financing that was utilized to fund the acquisition of the assets on the left-hand side. Because of the way it's structured, as you'll recall, the total assets have to equal the financing side. So when we say all assets deployed, it's the same as saying all financing utilized. And just keep that in mind. And because it takes capital and takes assets and capital to finance these assets, analysts are interested to know how the amount of profits generated compare to the assets deployed or the financing employed. And the two well-known ratios that are utilized to do that are called the return on assets and the return on equity. Now, return on assets measures profitability relative to all assets deployed and all capital invested. So it's neutral between debt and equity and the various types of financing. It just says all capital, all assets, which means all financing, without distinguishing between the various types of financing. So all the return on asset ratio is focused on is how much operating profit. And you focused on operating profit because it does not account for any finance related costs. So you get operating profit divided by total assets. That is a measure of profitability when using the ROA measure. And so the numerator came from the income statement here, and the denominator, total assets, came from the balance sheet. The return on equity is the other ratio that you see here. It focuses on shareholders' equity as a denominator. And because it's focused on shareholder equity, it needs a measure of profits on the numerator that is aligned with the shareholders' interest, which, as we discussed earlier, is net income. So if we take net income and divide by shareholders' equity, you get ROE. So this is a much more narrow measure of the profit generated relative to assets deployed, and it's viewed from a shareholder's perspective. But together, these two ratios reveal whether the company is generating adequate profits relative to the resources deployed by the company. So now that we've examined a few profit-related measures, we're going to turn our focus to operational solvency. And what we mean by operational solvency is really the ability of the firm to cover its obligations to its lenders, vendors, and other stakeholders. And when we look at solvency, we're going to look at two perspectives. One is the short-term solvency, meaning that can the company cover its commitments, near-term commitments, and keep the lights on in the short term? And after we are done with that, we will look at the company's ability to meet its long-term obligations. So from a short-term perspective, the The analyst's interest is in knowing if there are enough short-term assets at hand to cover short-term obligations. So the way they look at solvency is to see if the short-term assets are adequate to cover short-term obligations. Now, as we know from our balance sheet discussions, current assets are the best indicator of short-term assets, and current liabilities are the best indicator of short-term liabilities. So in effect, what analysts are doing is are comparing current assets to current liabilities to answer the question whether in the short term the company is solvent. And the simplest ratio that is used to assess short-term solvency is the current ratios, where all you do is divide the current assets by current liabilities. If the current assets exceed current liabilities, that is, the ratio is greater than 1, this indicates that the company has enough short-term assets to cover its short-term liabilities. So that's a good starting point for a solvency test. The challenge, though, is that that fits the profile and it's appropriate for many companies, especially companies that are financially doing well, has got plenty of liquid assets and generating significant profits. But what if you have a situation where most of the company's current assets are in the form of inventory, and there's concern that the inventory may not be converted to cash quickly enough to cover near-term liabilities? If there is such a concern, an analyst may need to modify the current ratio a bit. Um, and the way he or she would do that is by deducting out inventory in the numerator. So if you go from the first case, in the numerator was current assets. In the second ratio, you take out inventory from the current assets. The denominator is still the same. This ratio, where you take out inventory from current assets, so in effect reducing the size of the numerator, this ratio is called quick ratio, or sometimes even the asset test ratio. What we're doing in effect is recognizing that some of the inventory may be not liquid enough to cover short-term liabilities. Now, if in addition to concerns about the inventory, there's concerns about receivables as well, and you want to take out receivables too, in addition to inventory, you're left in with cash as the only item on the current assets side of the balance sheet. So you've taken out both receivables and inventory, so you're left with cash. So you now have a revised version of the ratio called the cash ratio, where you divide cash. Cash becomes the numerator. And clearly, the numerator is now even smaller than in the case of the quick ratio. But the denominator stays the same. This is clearly the most conservative measure of liquidity, and the general pattern you see, the more conservative the ratio, the stricter the test, and in some instances, the strictest test like cash ratio may not be warranted, and a current ratio test may be just fine. But the more tenuous the company's financial condition, the more the circumstances may call for a more stringent or a more stricter test. Now, in addition to these three ratios, the current ratio, the quick ratio, and the cash ratio, there are a couple of other ratios that you might see from time to time. One is called the net working capital to total asset ratio. What we do here is that rather than compute ratios of current assets to current liabilities, you take the difference between current assets and current liabilities. If current assets exceed current liabilities, that difference, the positive number, is called net working capital, and that is the numerator of this new ratio. And you divide that net working capital by total assets. So again, the numerator is current assets minus current liabilities divided by total assets. Another way of seeing how much of the assets are liquid in nature. Yet another measure of liquidity is called the defensive interval ratio. What they do with the defensive interval ratio is that you compare current assets to average daily operating costs. So the thought is that, hey, do I have enough cash to cover my daily operating costs on average? And you start looking at those kinds of numbers in circumstances where you're worried about not having access to external capital or being able to generate profit from your sales. In that case, it may become important to know whether you have enough current assets on hand to cover operating expenses for a few days. So so these are the many measures that are often deployed to figure out whether the company is solvent in the near term. And depending on the different circumstances of the company, some ratios may be more warranted than others. Now, with that from that short-term perspective, now we are going to start looking at the long-term perspective. Here, the question is whether the company is able to meet its longer term debt obligations. Similar kind of question as in the case of short term solvency. But the difference is that most of these liabilities are in the form of company loans and from banks or from third parties. So really the question is the company able to generate enough profit to cover or to make the interest payments on the debt? Now, as before, that ratio, by the way, is called the times interest earned ratio. And as before, we tweak this ratio a little bit by adding back depreciation and amortization because they are non-cash expenses, and you get a slightly different ratio called the cash coverage ratio, which is EBITDA over interest expense. Notice that just because the name of the ratio is cash coverage doesn't mean we're talking about cash. We're still talking about operating profit, but a more cash friendly, if you will, measure of operating profit, which is EBITDA. So really a variant on the theme of short-term solvency, but it's really about whether there's enough profit to meet the interest obligations associated with the loan. And that brings us to the final set of ratios that we'll cover in the video, the asset management ratios. And they fall into three categories: inventory management, receivables management, and asset efficiency, otherwise called asset turnover. Now, the inventory turnover ratio examines inventory relative to business activity. That is, is the inventory too high relative to the amount of goods sold? It is measured, as you can see from the page, by computing the ratio of inventory to cost of goods sold. So cost of goods sold divided by average inventory. Now, if we flip the ratio and divide the 365, the number of days in a year, by inventory turnover, you get to express inventory turnover in days, which is essentially saying how many days does the inventory sit on the shelves before being sold. Notice that because 365 is just a number, the information content in the day sales and inventory ratio is the same as the information content in the inventory turnover ratio. It's just expressed differently. Okay. So again, inventory management is about how much of inventory do you have relative to the amount of product you sell typically. Now, the receivables turnover ratio, the next ratio, is also similar. It examines receivables relative to sales. And it shows how much of the sales is in the form of credit sales that is converts to receivables. So you measure it by computing the ratio of receivables to sales. And when, again, if you flip it like you did in the case of inventory management, it is now presented in terms of days. So it tells you the average number of days it takes a company to collect payment after a sale has been made on credit. Or put it differently, how long the company's money is tied up in customer invoices before it's converted back to cash. Again, same information in the two ratios, two receivables ratios, just expressed differently. The third set of ratios is also similar in spirit. The difference here is that you're looking, instead of receivables at inventory, you're looking at either net fixed assets or total assets. So really you're trying to see how much is the sales relative to the assets deployed, right? And that's what for every dollar of assets, how much sales do you generate is the question that's being answered. And depending on the denominator, the ratios will vary slightly. All right, now that we have a high level sense of the various types of insights communicated by the ratios, there are a couple of points I want to make before we go further. The first is that the value of this discussion so far is not in how the ratios are computed. So it's not even, it's not at all critical to remember how each ratio is computed, because that information is readily available online and available from this video as well. But the real value is in the kind of insights that you can draw from the various ratios. So from a learning perspective, focus more on the interpretation of the ratios than on the formulas themselves. Now, as I alluded to earlier, different stakeholders are focused on different pieces of the analysis puzzle, and therefore they will focus on different ratios. So the next few slides, we'll take a look at what kinds of ratios different types of stakeholders focus on. And the first of these stakeholders we'll look at is the lender. Now, from a lender's perspective, the question is really, is the company a good candidate for a loan? And in order to answer that question, there are two questions that lenders will ask. Does the company have enough profits from its ongoing operations to cover its interest payments, that is, service its debt? And the second question is that if the loan goes bad, is there enough assets that the company has in excess of the loan amount to recover the loan? Right? So these are the two questions. So if you analogize to the individual case, if you think of a mortgage, the question here is, the first question is, do you have enough income to cover the interest payments or the mortgage payments? And the second question is that if you default, if you sell your house, is there enough value in the house to cover the mortgage loan? So really the same questions, but in the context of a company. As we have seen before, the ability to service debt is measured using the times interest earned ratio or the cash coverage ratio, where you're looking at the amount of profits relative to the interest expense. And on the asset coverage and leverage ratio, you're trying to see how much of debt relative to total assets. Here you're looking, the first ratio, the total debt asset ratio, you're looking at in the numerator, total assets minus total equity, which, as you may recall, is nothing but total liability. So it's trying to see how much total liabilities do you have to total assets. So if I analogize to a mortgage, loan to value ratio, right? Here you're looking at debt to total equity. How much is the debt relative to the owner's equity that's in the company? The long-term debt ratio just uh, narrows the focus only to long-term debt, because often the large amounts of debt that a company has may be in the form of long-term debt. And the denominator is different now because it's looking at the combination of debt plus equity. It's excluding all other kinds of financing, just looking at debt relative to debt and equity, again, to see what proportion of the long-term financing comes from the from debt, again, as indications of the amount of money that may be available for recovery in the event of default. Just like creditors, vendors too need to assess the creditworthiness of the company before extending credit. But one difference that a vendor may have relative to a creditor is that vendors tend to be focused on short-term financing, right? Because they provide um, uh, credit for the sale of a product which the company will pay off within a year. So the focus is a lot more on short term than the long term. So consistent with that, yes, they look at debt service capacity and the overall debt ratio like we saw in the case of creditors, but they additionally will look at liquidity assessments, the current ratio, how much current assets are relative to current liabilities, the quick ratio, and the more stringent cash ratio. So here again, the vendors are looking to see, hey, in the short term, do they have enough assets to cover the payments that are due to us, the vendor? The final type of stakeholder that we're looking at is the shareholder. Their perspectives are quite a bit different than from relative to a lender or a vendor. They are focused more on the upside because, they are as residual claimants. If the company goes just performs barely consistent with meeting the requirements of vendors and lenders, shareholders are not going to get very much. So they are focused on the upside potential than on downside risk. So as a result, their view is more expensive. They look to see if the firm is efficiently run by studying profits or returns relative to assets, like, for instance, the ROA and the ROE analysis that we saw earlier. They also look at operational efficiency through the turnover ratios that we discussed. They're looking to see if how much sales is generated for every dollar of assets that's deployed. That indicates how well the firm is run. The more efficiently the firm is run, the greater the profits that accrue to shareholders. They are, in the spirit of looking at the upside potential, they are very interested in growth metrics. They're looking to see how revenue is growing, how operating profit is going, how net income is growing. So hence the focus on growth metrics. And finally, they are very curious to know how the markets value the company, how the markets, how much the markets will pay for each dollar of earnings. And by the way, the earnings is nothing but another word for net income. Um, they look, if it's a company that is not making profits or earnings, then they might look at ratios such as price to sales ratio, another way to see how much the market is willing to pay for each dollar of sales activity generated by the company. And then finally, they might look at how much the market values the company relative to the book value of assets reported on the balance sheet. All of these are indications to shareholders about the market's assessment of the company's future potential and the expectations that the market has for the company. Okay, that brings us to the end of this lesson. The final takeaway I would mention here, and in fact, I'm going to reiterate a comment I made earlier. Financial statement analysis is not about memorizing formulas. It's about asking the right questions for the purpose of your analysis and figuring out which ratios will give you answers to those questions. So you identify those ratios, and once you identify that, you can compare it over time and compare it across companies to get a sense of how a particular company is performing, and then make decisions accordingly. Hope you found this lesson helpful. We covered a lot. If you have any questions, as always, feel free to reach out, and look forward to having you join us for the next lesson. Thank you very much for your time. Bye-bye.